The Market Maker's Edge Book Overview for Liquidity and Order Flow. Chapter 6. This chapter is a deep dive into the essential technical strategies that market makers use to identify profitable trading opportunities. It explains how technical analysis is not just about patterns and indicators but is a crucial tool in the hands of professionals who exploit retail traders' psychological biases. The chapter starts with an overview of why technical strategies are critical for market makers, emphasizing that while fundamental analysis may guide long-term investors, short-term price movements are dictated by supply, demand, and market psychology. The author explains key technical indicators and how they are used in real trading environments. One of the most valuable insights is the use of moving averages, particularly the 50-day and 200-day moving averages, which act as dynamic support and resistance levels. Market makers often use these levels to trigger stop hunts, induce liquidity, and take the opposite side of retail trades. Another crucial concept discussed is momentum indicators like the Relative Strength Index, RSI, and MACD. While retail traders use these to spot overbought or oversold conditions, market makers see them as signals for potential liquidity pockets where they can enter and exit positions profitably. A significant section of the chapter is dedicated to candlestick patterns and their role in market manipulation. The book explains how market makers use false breakouts, bull traps, and bear traps to trick traders into taking positions against the prevailing trend. A practical example provided is the pin bar and engulfing candle patterns, which retail traders interpret as trend reversals, but market makers use them to engineer liquidity pools before driving the price in the intended direction. A particularly eye-opening part of this chapter is the discussion on support and resistance manipulation. The author details how market makers push price to obvious resistance or support levels to trigger a flood of retail orders, only to reverse the market against them. This concept ties into stop hunting, a strategy where market makers intentionally drive price to known stop-loss levels to fill large institutional orders before moving the price in the intended direction. Notes from Chapter 6, Why this matters. Read the section on moving averages carefully. It explains how institutions use these levels to trap retail traders. Focus on the false breakout strategies. This is where most traders lose money, and understanding it can give you an edge. Study the candlestick patterns analysis. It is not about the pattern itself but about who is trapped in the trade and where liquidity lies. Pay attention to stop hunting and liquidity pools. Market makers think in terms of liquidity, not patterns. Understanding this concept can change your trading perspective. Chapter 7, Order Flow, the Hidden Language of the Market. This chapter shifts the focus from technical indicators to the mechanics of order flow, which is arguably the most important concept for a trader wanting to think like a market maker. Order flow analysis is about reading the intentions behind price movements rather than just reacting to price charts. The chapter begins by explaining the importance of liquidity in the market. It introduces the concept of buy-side versus sell-side liquidity, showing how institutional players, market makers, hedge funds, and large traders seek out liquidity pockets to execute large orders efficiently. The discussion moves to the order book, where bid and ask prices reveal where liquidity is resting. One of the key insights here is that the visible order book, Level 2 data, only tells part of the story. Hidden orders and iceberg orders often mask true market intent. A large portion of this chapter is dedicated to the mechanics of market orders versus limit orders. The author explains how retail traders tend to use market orders, while professionals use limit orders, allowing them to control price movements. This ties into the idea of passive versus aggressive order flow. Passive liquidity providers, market makers, profit by absorbing market orders, while aggressive traders pay higher spreads by chasing price movements. The most critical takeaway from this chapter is the discussion on stop runs and liquidity sweeps. The author explains how large players engineer price movements to trigger retail stop losses and induce FOMO-driven market orders. An example is the classic stop run before a major trend move, where the price briefly spikes against the prevailing trend to shake out weak hands before continuing in the original direction. This is a deliberate attempt to clear liquidity and ensure smoother execution for large orders. Another key concept introduced is volume profile and time and sales analysis. Market makers use volume imbalances and delta divergence to gauge when the market is accumulating or distributing positions. High volume at a support level is often a sign of accumulation, not a breakdown, while low volume breakouts are often false moves designed to trap traders. Notes from Chapter 7, Why this matters. Focus on liquidity concepts. Market makers don't trade based on charts, they trade based on liquidity. Understanding where liquidity is helps in avoiding traps. Study the section on stop runs carefully. Retail traders often get stopped out right before a big move. Knowing how market makers engineer these moves can help you avoid them. Understand aggressive versus passive order flow. This explains why retail traders lose money entering at the wrong time while market makers profit from their mistakes. Pay attention to volume and delta divergence. If volume isn't supporting the move, it's likely a trap. Learn to differentiate genuine price action from manipulation. Final thoughts on Chapters 6 and 7. These two chapters are a must-read for anyone serious about understanding how markets truly work. The author does an excellent job of breaking down the technical strategies and order flow dynamics that drive price movements. If you're trading based on charts alone, you're likely missing out on the deeper mechanics that control the market. My recommendation: read Chapter 6 if you are still relying on basic technical indicators. It will help you understand why patterns alone aren't enough. Chapter 7 is crucial if you want to think like a professional. Order flow is the real edge in trading, and this chapter explains how to spot liquidity traps, stop hunts, and institutional footprints in the market. By mastering these two concepts, you can shift your mindset from a retail trader to a market maker's perspective, allowing you to trade smarter, avoid being manipulated, and significantly increase your odds of success.